Hello, investors! Have you ever wondered if you can invest in real estate without buying properties? In this video, I'll go over real estate investment trusts, better known as Reits. A business that invests in real estate with an income-producing potential is known as a REIT. In order to gain access to real estate, investors can purchase shares of a REIT, and by doing so, they are able to add the real estate that the REIT owns to their portfolios of investments. Investors can access all of the REIT's properties through the investment without buying physical real estate. REITs were designed in 1960 to provide regular investors with a cost-effective way to invest in diversified portfolios of real estate that generate income. By law, a REIT must adhere to a particular set of operational standards in order to be considered one. REITs must meet the legal requirements that their real estate assets account for at least 75% of their gross income. Additionally, they must allocate at least 75% of their total assets to real estate. Law also mandates that REITs pay at least 90% of the profits from their real estate holdings to investors in the form of dividends. Investors can purchase shares of a fund in a number of ways after it successfully meets the requirements to become a REIT. Using this capitalization as a pool, the REIT invests in various real estate ventures. The straightforward ownership of real estate by the REIT, real estate loans, or both are examples of investments. There are several different types of REITs. The first I'll go over are data center REITs. Data center REITs are a specific kind of REIT that owns and operates properties that give clients a secure location to store their data. An advantage of investing in a data center REIT is that the demand for this infrastructure to house servers and other information technology hardware is on the rise dramatically and shows no signs of abating anytime soon. Despite the state of the economy, customers continue to use their smart devices. Even in a time of economic unrest, needs persist. Even as physical offices were being replaced by virtual ones during the pandemic. In difficult times, their expansion may slow down, but they won't disappear entirely. One of the risks of investing in a data center REIT is increased competition from tech giants like Microsoft, Google, and Amazon. Oversupply and vacancies are a concern as development and profit potential are put under pressure by these companies. Retail REITs are another popular type of REIT. Real estate that is used for retail is owned, managed, or leased by retail REITs. They make the majority of their money by renting out space to tenants. Examples of retail REITs are home improvement stores, shopping malls, grocery stores, and big box stores. An advantage of investing in retail REITs is that they have long-term tenants. They can have leases that are 10 to 20 years long. In addition to their monthly rent, tenants are also responsible for operating, insurance, tax, and maintenance costs. Typically, these tenants are long-standing businesses with steady cash flow. Even with recurring rent increases, a tenant defaulting on their rent is extremely unlikely. They also have anchor tenants. The best locations for anchor tenants are shopping centers, outlet malls, and grocery stores. These are the main businesses in the area that bring in the most money and draw shoppers. As a result, other businesses will desire to be in this desirable location, making vacancies unlikely. A risk of investing in retail REITs is the rise of e-commerce. Online shopping by consumers is expanding, which has an impact on physical store sales. There are more vacant spaces because many businesses are closing down. Another risk is rising interest rates. When interest rates are high, they can have a negative impact on the stock prices of retail REITs. Real estate associated with healthcare is owned, managed, and rented out by healthcare REITs. Hospitals, medical office buildings, and senior care facilities are examples of healthcare REITs. An aging population is one of the reasons healthcare REITs can be a good investment. Undoubtedly, there will be a significant increase in demand for senior housing and healthcare due to the influx of baby boomers who are rapidly approaching retirement age. The number of people aged 65 or over will rise by almost 44% over the next 20 years. The demand for all types of healthcare-related real estate will rise as a result across the nation. Another advantage of investing in healthcare rates is that healthcare is a necessity. There is always a need for healthcare, regardless of age, as the previous year has demonstrated. The elderly were the most affected this past year, but people of all ages required more access to healthcare than ever. The need for more hospitals and medical offices has expanded to include more than just yearly checkups. The demand for senior housing and skilled nursing has grown as children were unable to care for their aging parents. For many baby boomers, living in senior housing is now a necessity rather than just a luxury. The impact of the COVID pandemic is considered a risk of investing in healthcare rates. The pandemic has had a devastating financial impact on the operators who rent the facilities from the rates. Some may take years to recover, while others might never do so. This suggests that the stabilization of rents might take some time. Competition is another risk of investing in healthcare rates. There is fierce competition now because there is a greater need for various types of healthcare. In-home care and other services are now more widely available to people. With these options and alternatives, this already fiercely competitive industry is sure to intensify its rivalry. Competitors who are qualified professionals are also included. Operators would have to spend more money to retain their current staff and/or hire new staff if there was a potential shortage of qualified workers. Office rates own, manage, operate, and lease office buildings. Banks, law firms, and high-end offices are examples of office rates. An advantage of investing in office rates is that they rent to major corporations that have leases for 5 to 10 years. This provides predictable income for a set time period. Investors will face a significant risk from the global economy. The use of office space by smaller businesses will be impacted by downsizing and remote working. When their lease expires, they cannot extend it. An excess of office space may result from this. Next are mortgage rates. Simply put, mortgage rates create or acquire mortgages and mortgage-backed securities. The interest on those mortgages generates income for them. Many mortgage rates also own income-producing real estate, though both residential mortgage rates and commercial mortgage rates derive the majority of their income from interest payments on the debt they own. Investing in a mortgage rate has many advantages, including the fact that mortgage rates typically have higher dividend payouts with yields over 6%. Millions of residential properties are financed with the aid of mortgage rates, which is crucial for the economy. The housing market's facilitation has a significant impact on the economy. Mortgage defaults are a major risk for mortgage rates. There is no profit to be made from the interest when borrowers default on their mortgage. When people invest in mortgages that are not guaranteed by a federal agency, investors run the risk of losing money. Rates value may decline as interest rates rise. Since mortgage rates buy the mortgage securities they invest in with short-term debt, rising interest rates may reduce their profit margins. Even though rates have been around since 1960, individual investors just embraced them around 10 years ago. Adding rates to your portfolio will position it to have impressive returns over time. For more content on investing, please like and subscribe to the channel.